Imagine you're at a massive party, the music's booming, the crowd's hyped, drinks are flowing, it's like no tomorrow. But then something shifts. The bar slows down, fewer drinks are being served, and suddenly the energy changes. People start leaving. Now, is the party over? Or is it just a pause before things go wild again? That's exactly what's happening in the crypto market right now. Liquidity, the fuel that drives Bitcoin, stocks, and risk assets, it's drying up. The dollar is stronger than ever, keeping money locked out of the system. And until that changes, we're stuck in limbo. But here's the thing, this exact pattern has played out before. And if history repeats itself, we could be on the verge of one of the largest market shifts in years. The question is, are we about to see the start of a bear market? Or is this just a reset before the next explosive rally? Well, smash that like and let's take a look. Crypto markets aren't just driven by numbers. They run on emotion. And right now, fear is in control. Headlines are screaming about crashes, exchanges shutting down, and investors running for the exits. Social media is flooded with panic. But is this fear justified? Or is it another classic case of overreaction? Think of the crypto market as a packed nightclub. The energy's electric. Everyone's having a great time. What? You thought I only talked about money. You didn't know I could dance? What? All right, let's get back to it. But then someone yells, fire! A few people rush toward the exit. Others follow. Not because they see flames, but because they assume something's wrong. That's how markets work. Stocks, real estate, crypto. Fear spreads like wildfire, triggering panic selling even when the fundamentals remain intact. Right now, we're watching that fear play out. The fear and greed index is flashing extreme fear, a level that in past cycles marked the bottom rather than the start of bigger crashes. But this time, fear isn't the only factor at play. The real issue, liquidity. And liquidity, in simple terms, means cash flowing in the market. And this liquidity also, it's not like a you and me liquidity. It's the trillions of dollars that float between institutions and governments. That's the liquidity I'm talking about. The global economy is running dry on cash. The dollar is stronger than ever, making it harder for other countries to print money. The DXY measures the dollar's value against a basket of other currencies. A rising DXY indicates a strengthening dollar, which can correlate with reduced global liquidity. Until that shifts, until the US weakens the dollar through trade deals or monetary policy, liquidity remains low and risk assets like crypto struggle to grow. Adding to the pressure, macroeconomic forces, so big picture forces, are stacking up. Interest rates, they're high, keeping investors cautious. And economic uncertainty, it's rising, making people less likely to take risks or take loans. Regulatory crackdowns are hitting crypto, fueling even more fear. So the real question isn't just whether the market is crashing, it's whether we're witnessing the perfect setup for the next major rally. Because historically, this is exactly how the biggest opportunities emerge. Let's break it down. Crypto, like all financial markets, move in cycles. Expansion, peak, contraction, bottom. The question now is whether we're entering a bear market or just experiencing a routine cool down. Picture Bitcoin like a roller coaster. It climbs higher and higher and higher, but then suddenly it drops. But experienced riders know not every dip means the ride's over. Sometimes it's just gearing up for the next big climb. And right now, Bitcoin has pulled back sharply after hitting a peak, sparking panic. Some believe it's the start of a long, painful bear market. But if we zoom out, 20 to 30% pullbacks occurred in every strong bull market before. So what are the signs that we might be entering a bear market? A liquidity squeeze is underway. A strong dollar and tight monetary policy means less capital flowing into crypto. Retail interest is fading with Google search trends and trading activity dropping. And if Bitcoin fails to hold 80K, it could trigger a deeper downturn. Speaking of downturns, let's talk about altcoins. Often they're the first casualty when the market turns bearish. Altcoins are bleeding out. Is that the first sign of a bear market? While Bitcoin's usually the last to fall, altcoins, especially the smaller gambling speculative ones, start showing cracks much earlier. But does that mean we're officially in a bear market, or are these just normal corrections in a volatile space. A classic warning sign of a broader downturn is when Bitcoin holds relatively steady, but altcoins begin to bleed. We've seen this pattern before in past cycles. Altcoins soared during bullish euphoria, but lost value quickly when liquidity dried up. Right now, we're witnessing a similar divergence. Bitcoin dominance is rising, meaning investors are shifting their capital into Bitcoin while shedding riskier altcoin positions. This often signals growing uncertainty in the crypto market. Take Ethereum, for example. While ETH usually moves in tandem with Bitcoin, its recent underperformance against Bitcoin suggests that investors are de-risking. Even solid projects like Solana and Avalanche, which saw strong rallies in the last bull cycle, are losing momentum. Meanwhile, smaller cap tokens are getting crushed, some losing over 50% from their local highs. So why are altcoins dropping faster? Well, it comes down to three main factors. Liquidity is drying up. When investors get nervous, they rotate their holdings into safer assets, with Bitcoin seen as the safe haven of crypto. Speculative hype is fading. Many altcoins rise on narratives and excitement, and once that cools, their prices collapse, much faster than Bitcoin or Ethereum. And regulatory pressures are adding uncertainty. Unlike Bitcoin, which enjoys a lot of institutional backing and regulatory clarity, many altcoins face legal uncertainty, accelerating their decline. The key question is whether this is a typical altcoin correction or an early stage bear market signal. One major factor to watch is Bitcoin's performance. If Bitcoin continues holding strong while altcoins decline, it suggests a temporary rotation rather than a full-scale bear market. However, if Bitcoin also starts breaking key support levels like the 80K range, we could be looking at the early stages of a deeper downtrend. Another critical metric is altcoin trading volume. If volume drops significantly alongside price declines, it signals buyers are losing interest, a bearish sign. On the other hand, if strong altcoin projects see a bounce back, this could indicate just a routine market shakeout before another big run. But let's circle back. What's happening with Bitcoin? Understanding Bitcoin's pullback. Bitcoin's volatility is nothing new. Sharp pullbacks have always been a part of its price cycle. Historically, after major rallies, it drops 20-30% before the uptrend resumes. But the difference between a routine correction and the start of a deeper decline comes down to three key factors. First, volume and selling pressure. Is the selling happening gradually, signaling healthy profit taking, or is it sharp and panic driven, pointing to deeper fear? Next, key support level. If Bitcoin stays above crucial zones like 80 to 82K, that's a signal for resilience, but breaking below them could trigger a larger downturn. And finally, market sentiment. Is this just a momentary cooling off period, or are investors showing clear signs of fear and capitulation? That means freaking out. Right now, Bitcoin's correction seems controlled rather than chaotic. But even if support holds for now, there's another layer to consider. External forces that could shape the next big move. But before we get into that, we need to understand that Bitcoin doesn't move in isolation. It's increasingly tied to broader macroeconomic trends. So one major factor is interest rates policies. If the Fed Reserve keeps rates high, liquidity dries up, and risk assets like crypto tend to struggle. Then there's stock market correlation. In recent years, Bitcoin has moved in sync with equities, meaning a downturn in traditional markets can drag it down too. But let's not forget regulatory uncertainty. Legal battles and potential government crackdowns on crypto firms create hesitation in the market. So far, Bitcoin is holding up better than many altcoins, suggesting it remains a preferred asset during times of uncertainty. But that raises an interesting question. If the broader market conditions aren't ideal, why hasn't Bitcoin taken an even bigger hit down? Well, one possible explanation lies in the behavior of investors. Who's really driving the market now? You see, when crypto prices start to drop, many assume retail investors are panic selling. But is that really the full picture? The key to understanding whether this is just a temporary dip or the start of a prolonged bear market for crypto lies in identifying who's driving the price action. Is it retail or institutional investors? By retail, I mean individuals like you and I buying and selling in smaller amounts. These are usually the first to react emotionally to market swings. Right now, the signs suggest growing hesitation. Google search interest in crypto's cooled a lot, a sign that casual investors are losing excitement. At the same time, on-chain data reveals a decline in smaller Bitcoin transactions, indicating that fewer retail traders are actively buying or selling. Even the Fear and Greed Index, which tracks overall sentiment, has shifted from greed to neutral or even fear, suggesting that confidence is starting to fade. Now, historically, these patterns have aligned with early stage market slowdown, but retail panic alone isn't enough to confirm a bear market. The real test lies with institutional investors. Unlike retail traders, institutions like hedge funds, venture capital firms, and asset managers approach market movements with a more calculated strategy. Some institutional investment products, such as Bitcoin and Ethereum ETFs, are still seeing strong inflows, which suggest long-term interest has not disappeared. They're just buying the dip. Reserves like USDT and USDC on exchanges are rising, a potential signal that big players are waiting for better buying opportunities. On-chain data also shows that large Bitcoin wallets, often referred to as whales, they haven't exhibited mass liquidation, meaning institutions may not be in full risk-off mode just yet. So far, the data paints a clear picture. Retail investors are showing signs of fear, but institutions haven't fully backed out. That distinction is crucial. If institutions begin accumulating during this dip, the market could stabilize and recover quickly. But if we start seeing significant outflows, particularly from ETFs or major crypto funds, it would be a much stronger warning sign that a deeper downturn is on the horizon. At this moment, the market is at a crossroads. Retail investors might be stepping back, but the real question is, will institutions step up? The answer to that could determine Bitcoin's next big move, liquidity crisis. But it's not just investors we need to look at. Interest rates, inflation, and liquidity trends also have a huge influence on the market sentiment. And right now, those macroeconomic conditions, those big picture things, they aren't exactly setting the stage for a crypto bull run. One of the biggest tailwinds for Bitcoin's previous bull run was easy money as a result of low interest rates and aggressive money printing. But that's no longer the case. The Federal Reserve has kept interest rates at multi-decade highs in an effort to fight inflation, making risky assets like crypto less appealing. With higher rates, investors can earn solid returns on safer assets like bonds, reducing the urgency to bet on Bitcoin. On top of that, liquidity is tightening. When central banks inject money into the economy, a portion often finds its way into speculative assets like Bitcoin. But right now, instead of adding liquidity, the Fed is draining it. We've seen this pattern before. When money is cheap, Bitcoin thrives. When money is expensive, Bitcoin struggles. And we already know that a crypto bull run requires fresh capital flowing into the market. But with borrowing costs at their highest in years, global economy is struggling, and investors leaning toward a risk-off approach, it's unclear where that next big wave of money will come from. Unless macro conditions shift, which they can, and I think they will, either through central banks easing monetary policy or some unforeseen catalyst, crypto may have an uphill climb in the short term. Does history say the party's over? While there are news of doom and fear in the crypto space right now, we need to understand that crypto has always been a game of cycles, swinging between explosive bull runs and brutal bear market. The biggest question for traders and investors right now is whether this is just a dip or the start of a full-on bear market. The answer lies in key price level. For Bitcoin, analysts have identified 80K as a crucial support level. If prices break below this and stay there, it could signal a deeper bearish trend. On the flip side, Bitcoin recently fell below 90K, making it a significant resistance level. If it manages to reclaim and hold above that level, there's a strong chance of a quick bullish reversal. Ethereum's facing a similar dynamic. The 2150 mark has been highlighted as an important support level. If the price drops below that, selling pressure could accelerate. Meanwhile, the range between 28 and 3K remains a critical resistance zone. If ETH breaks through that level with strong momentum, it could just clear the path for further forward momentum. Like, it's just gonna go, in my opinion. To determine whether the bull run is truly over, it helps to compare today's market to past cycles. In 2013, Bitcoin began the year at about $13. It experienced a significant rally, peaking at over 1,100 on December 4th, 2013. During this period, there was a notable retracement of almost 50%, followed by a surge to new highs. If today's pattern follows this trend, this could just mean a mid-cycle correction before continuing an upward trajectory. And that's my opinion. But 2018 tells a different story. Back then, Bitcoin hit a peak and then it bled out over the course of a year, dropping 84% and forming low highs. Back then, Bitcoin hit its peak and then bled out over the course of a year, dropping 84% and forming lower lows along the way. If that's the cycle we're repeating, a prolonged bear market could be ahead. The 2020 crash offers yet another perspective. Bitcoin plunged 50% within weeks, right after I had just put a bunch of money in, only to roar back as buyers flooded in. If today's downturn follows that blueprint, we should start seeing clear buying pressure soon, which would suggest the bull run isn't over yet. What would signal a recovery? Well, if Bitcoin bounces back above 100K with strong volume, that could be the ultimate confirmation that the bull run is still alive. A surge past that level would likely mean institutional buyers are stepping back in. Retail investors are getting back in the game, and FOMO is about to take off, baby. So what's next? Well, if Bitcoin keeps breaking below key support levels and struggling in recovery, a full bear market might be on the horizon. But if strong buyers step in, history suggests this cycle might still have plenty of room to run. And right now, the market is at a critical crossroad. If Bitcoin and ETH hold key support levels, the bull run isn't over yet, baby. But if they break down, history says statistically we could be in for a much longer crypto winter. For now, the best approach is to stay informed, watch for key technical signals, and remember, whether bull or bear, crypto markets always reward those who play the long game. Now, smash that like, hit follow for your guy, and I'll catch you on another video, baby. You keep living your life to the fullest. Peace.